Welcome everybody to the Office of Economic Empowerment's Money Talk Tuesday, Credit Building 101, How to Improve Your Credit. And today we're presented with Boston Builds Credit. So this is a quick little agenda. We're gonna go over about the Office of Economic Empowerment disclosures, housekeeping, and then we'll introduce you to our speakers. Do stick around. The last few minutes, we do have an exit poll to help us get some feedback on these webinars. And this is the opportunity to suggest ideas for future Money Talks. The Office of Economic Empowerment is a department within the Office of the Treasurer and Receiver General of Massachusetts, tasked with supporting, advocating, and facilitating policies that empower all Massachusetts residents. Our programs serve women, families, high school students, veterans, and seniors. Our priorities include closing the wage gap, increasing access to financial education, improving college affordability, and investing in STEM careers and education. Our disclosure, this is a Zoom webinar and will be recorded. We're recording and we're streaming live on Facebook. The recording may be uploaded onto a public website for future use. This webinar is also streamed live on Facebook. Any information shared through the question functions will be anonymous. Please note, however, that the chat record is subject to public record laws and as such is not anonymous. Some quick housekeeping. This is a webinar, not a meeting, just to reiterate. As such, you will not be able to view other participants. The host can call on participants to answer questions. You can use the chat feature to communicate with the host and panelists, or you can use the Q&A option, which will be available throughout the webinar. And a reminder again, please complete the exit poll. This helps us do a better job at these things. And also feature stuff that you guys want to hear about. And then finally, our next Money Talk is July 28th at noon with Angelo Newby from Mass Housing. You can register at the bit.ly in the invitation, and we're also advertising it on our Facebook page, or you can email us for the direct link. If you have any Money Talk questions or concerns, please email us at moneytalk@trade.state.ma.us, and I will drop a bunch of links throughout the webinar into the chat if that was too quick for you to catch. Thank you all, and without further ado, I'm going to hand it off to our lovely Allison Kroner-Barron from Boston Builds Credit.
Good afternoon, everyone. Thanks for joining us on this webinar. My part of this will be very brief. I am the director for Boston Builds Credit, and I just wanted to introduce myself and the initiative before I hand it over to our lovely coaches, Jason and Jenny, to tell you all about credit. The mission of Boston Builds Credit is to make credit work for all Bostonians. And we do that through two big ways. One, we get the word out about how credit works and how you can build your credit and address any other major financial goals you have. We do that through webinars like this one, through webinars held by our partners, and when we are allowed to be in person and again, in-person workshops, as well as a big network of financial coaches, both in Boston and some throughout the state, that help you identify what financial goals you have and go out and achieve them. So Jason and Jenny are two such coaches, and they're really experts in this field, and I am excited to turn it over to them. We also focus on systems change strategies. I won't get into that on this webinar, but if you are interested in learning more, you can visit our website. You can send me an email through there, and if you want to get involved in helping us set our priorities, we are about to launch a community advisory council either late this week or next week. So go ahead and send me an email through the website and let me know that you're interested. Without further ado, I will turn it over to Jason and Jenny.
Hello, awesome people. Warning, I think everyone is experiencing this because we're all at home. So if you see little children come running this way, we're just gonna pretend. So my name is Jenny Jaffard. I am the Business Alliance Coach with Boston Ujima Project. And Boston Ujima Project is a democratically run organization that really focuses on creating another Boston, seeing that another Boston is possible, where the communities the people that live within the communities really shape the decisions that are being made for those communities. So supporting the businesses that are there, investing in the businesses that are there. Our website is ujimaboston.com. So as the Small Business Alliance coach, we have a Small Business Alliance that allows businesses to get the support of the organization through grassroots organizing, through creative marketing. So we're super excited to be on this webinar with you guys. And I'm gonna pass it to Jason to introduce himself.
Thank you, Jenny. It's really nice to be here with everyone today. Yeah, I'm really excited to talk about credit with everyone, with Jenny. So I'm Jason Andrade. I'm the Director of Financial Services with Compass Working Capital. Compass Working Capital is a nonprofit financial services organization really focused on helping families, specifically low-income families, build wealth and financial stability. And we really do that, one, focusing on financial coaching and providing great resources to our families, but specifically working with public housing authorities and to help them run what we call, or what is called FSS, which is Family Self-Sufficiency Program, which is this really phenomenal kind of what we call like well-kept secret in housing, where families and individuals who are working through the program over 5 years can defer a certain percentage of their increase in earnings through work into a savings account, which they can later leverage to purchase a home or save for retirement or save for their children's education. So, we're excited. Our work is really close to families who are looking to build their credit, build assets, and we're excited to be a part of this presentation. It's a way for us to share more about our programming for folks who are interested, who may be eligible, and for us to, share great information to the folks throughout Boston. So really happy to be a part of this presentation and talk to you guys about credit today. Great. So what we'll do now is we'll just jump and dive right into the presentation. Benny's going to be leading the first half of the presentation. We do have some poll questions that we want to ask the group as well, just to get a better sense and hear from you guys directly on, what are pressing issues or what are things that are really at the top of your mind that you want to discuss or hear about in terms of credit. So we'll get started with the presentation, and then I think we can also share the poll with you folks as well. So the poll question that we have for you guys is, what's your biggest struggle when it comes to managing your credit? Please select all that apply, and please remember to scroll down. There is one question at the end of the group as well.
Shaitia from OEE here. As you guys are answering these polls, always note that there's the opportunity to expand, or if the option isn't there, you can put it in the chat. If you do submit questions in the chat, we are going to do our best to address those towards the end. But go ahead and continue to use the chat and the questions. As we see them, we'll just note the questions towards the end. And Jason, when you get a chance, could you repeat that poll question for one of our viewers?
Yeah. Give me one here. It's a list of different items here, but what is your most pressing or credit question or credit issue that folks are facing at the moment?
I feel like there should be the Jeopardy song on right now.
I was just singing it in my head, Jenny.
I'm gonna leave the poll open for another 20 seconds. Well, actually 10 seconds.
And I see some great questions in the chat.
Yes. Great. So we'll make sure that we get to all those, or we'll try to get to most of those questions at the end of the presentation. There should be, and we'll have a good amount of time to answer kind of questions and go over these. So the question again was, what's your biggest struggle when it comes to managing it? And the top response that we received in the poll was, I don't understand how credit works, with 40% of the polls. That's great, because our presentation today is really going to be on some basic fundamentals that Jenny and I are going to walk you guys through around credit, how it works, what are things, best practices, and what you really guys should know so that you can build and protect your credit, especially during this pandemic time when there's a lot of scams and different things going on that people should be aware of. Great. So I am going to present. I'm going to start presenting.
Thank you, Jason. It's not showing the screen yet. So we do have some, looks like majority of the questions is about how do we build our credit. And before we get into the how, we're going to start with the why we build credit. Oh, actually, let me back up a little bit. What does this workshop cover? So this workshop will cover why credit is important. I feel like majority of us have an idea of why credit is important, especially if you've been living your day-to-day life. We want to talk about what credit is. My goal is, Jason and I's goal is at the end of this workshop, you would have a fundamental basic understanding of what credit is and how to make it work in your favor. And then the third is how to build, and I'll add protect your credit during COVID. So let's talk about why building credit is important. There's several different reasons why. And I think majority of everyone can say that they've experienced this, that when they have attempted to apply for a car, a home, a credit card, even your cell phone, they will require you or ask you to pull your credit. So jobs, cars, utility bills, housing, credit cards, cell phone bills, all of that is important, because when your credit is better, your life tends to be less expensive. So you have ability to have access to certain jobs that are only available to you with better credit and more. Now, we build credit because having good credit can help you access products and services. One of the things that I highlighted is a job. There are certain jobs that especially if you're working in finances and working in high-level administrative jobs, even if you want to be a lawyer. I had a client who wasn't allowed to take her board exam because her credit was low. So you have access to products and services. You save money with lower interest rates and or fees, which we're going to show you how that number breaks down further on in the slide. You can weather an emergency or financial shock. And I think every single one of us can relate to weathering an emergency, since we're all living through our first pandemic. So what is credit? Credit is honestly a contract in between two parties that debt will be repaid. Think of it as an IOU. You're saying that I have the ability, I want this product and I have the ability to pay for it. and I'm putting my name. Credit is your good name in the financial world. Credit history is the record of all of the transactions that you have involving credit and other products and services. And your credit score is a 3-digit number that's generated from all of the information on your credit report, which basically gives financial institutions a evaluation of the riskiness of you as a consumer. So it basically says, what's the likelihood that this person is going to pay us back? So that 3-digit score is telling these financial institutions that this is, we're going to say, Susan's ability to pay back on her debt. So businesses, I like to do a quick history lessons. Business, that's a great question, Calvina, and I'll answer that. What credit history comes from businesses trying to track customer accounts and activities, and that information comes all together in a credit report that's held by the 3 credit reporting agencies, which is TransUnion, Experian, and Equifax. Now, a question that Calvina asked was, what if you don't have a credit, what if you don't have debt? Debt is the way that you build a credit score, unfortunately. So oftentimes what I've learned, what I've noticed within clients, especially if you're young or if you've never had debt, is that you aren't showing up in the record for the credit report agencies. There's 3 things that you need in order to generate a credit score. You guys ready? 3 things. 1, you need an active social security number that's not showing that you're dead. It just says that you're alive. So that's the first requirement to generate a score, that you're alive with an active social security number. The second thing is you have a line of credit that's been open for 6 months. And then the third thing is that line of credit reports to the credit reporting agencies within 6 months. So again, you're alive in America. Number 2 is you have a line of credit that's been open for 6 months, and that line of credit reports to the credit reporting agencies within 6 months. We're going to go to the next slide. So let's talk about what is on your credit report. Oftentimes, when you don't have active, positive accounts on your credit report, one of the first few things that you see is the negative information, which is the collections, the judgments, the public records, anything that remember the slide before when we talked about why is credit important? For your cell phone bill, for your car loan, all of that information, when they pull your credit, if you end up not being able to pay, it shows up as a negative reporting account, medical bills, cell phones, bankruptcy, all of that. So what always shows up is the payment history for certain accounts. So student loans, auto loans, credit cards, and mortgages. Student loans, again, to go back to the question, one of the questions that was asked in the chat, one of the reasons why usually the first time someone generates a credit score is when they apply for a student loan. So we have a lot of young adults under the age of 17, 18, that they are credit invisible. And the first time that they generate a score is when they apply for student loans. So what's in a credit report? There is 4 main areas that you should be aware of when you're looking at a credit report. And just really quickly, how do you get your credit report? It's on annualcreditreport.com. And the 4 main areas that you see on your credit report is the personal identifying information. So in that section, you will see information of old addresses, old employer information, as well as old phone numbers. One of the best tips that I tell all of my clients is you want the most up-to-date information in the personal identifying section as possible. You shouldn't have too many old addresses because it makes you look like an unstable consumer. The second area is credit history. This is when you'll see a list of the credit lines that you have open. One of the things that to keep in mind, depending on the credit report, is sometimes they'll separate it between the negative impacting information and the positive impacting information. Public records shows judgments, bankruptcies. That's where you're going to see anything that required information from a courthouse is most likely going to be on the public records section. And then inquiries. Inquiries is how many times you pull your credit report. Information on your credit report varies across the board. The average is 7 to 10 years that certain information lasts. Bankruptcies tend to be 10 years or 10 years. Inquiries is 2 years or less, and all the other information falls within the 7-year gap. There are 2 types of credit accounts. The first is an installment account. And when you think of installment, think of something that you are consistently paying a fixed amount. So car loans, student loans, personal loans, mortgages. That set amount is loaned up front and then paid back in equal payments each month. Now, revolving accounts is your credit cards, and think of it as a revolving door. There's no fixed amount. You borrow what you choose within a preset limit, but payments each month depend on what you borrowed. So credit cards and personal lines of credit are examples of revolving accounts. This is my favorite part, you guys, and I'm gonna geek out a little bit. All right, so what makes up our score? This is the FICO algorithm pie. When you understand the pie, you can make it work for you. So payment history counts for 35% of your score. And payment history is simple. Do you pay your bills? Is it on time? So the 3 things that I want you guys to know when it comes to payment history is that there's 3 dates that are important. It's the due date, so the date that the bill is due, your statement date, which is the date where any interest accrues on the balance on your debt. So oftentimes you'll see that with your credit card. And then the third is the reporting date. The reporting date is important because that's the date that, let's say, the credit card company, we're going to say Capital One, that's the date that Capital One reports to the credit reporting agencies your balance. Why is that important? That's important because when you are aware of the reporting date, you can control the number that is then shown on your report, on your credit report on a monthly basis. Sometimes the due date when you pay that bill and the reporting date can be 2 different dates. For example, the Capital One credit card, oftentimes the due date is the 1st of every month, but it doesn't report to the credit reporting agencies until the 5th. So between the 1st and the 5th, you have time to either decrease the balance on that card so that a better score, a better balance is reporting to the credit bureaus. And I apologize, you guys, while the presentation is going, I don't see the full questions unless I go into the chat. And I want to give us time to answer all of these questions during our Q&A. So it's not that I'm ignoring the awesome questions that I see parts of. It's just I want to make sure that Jason shares his portion and we give room for the Q&A section, okay? but continue to write in the chat the questions, and maybe Jason and the intern can support with starting to answer. Let's continue. The 30% of what makes your score is the amount of debt, also known as the credit utilization. That counts for 30% of your score. And that basically, the best way that you can keep that into mind is a credit card. Let's say you have a limit of $100 on that credit card. If you are using $90 of that credit card, you are using 90% of your utilization rate. The goal is to really have that under 10%, but preferably between 1 and 7%. And then the other section is the length of credit history, so how long you've had credit. New credit, the amount of credit that you apply, new credit, which is inquiries, and then credit mix is the different types of accounts, so installment and revolving. I saw a question about hard inquiries. Whenever someone asks you for your social security number, consider that a hard inquiry. So whenever, if you're in Macy's and Macy's says, do you want to save 10%? That's how I got caught. 10% on your purchase today by opening an account, and they ask for your social security number, that is a hard inquiry. So there's a soft inquiry, which is whenever you check your account. And then a hard inquiry is whenever someone is pulling your social security number to open an account on your behalf. And we're going to go on the next slide. All right. I believe that I'm going to tag team my partner, Jason, into this space, and then I'll jump in the chat for supporting with questions. Jason, your turn.
I'll go over, thank you, Jenny. I'll go over this slide, and then we'll ask another poll question, and then I'll finish through the second half of the presentation on building credit, and then we'll try to answer all the questions. So what does your score mean, right? And I think this is an area where people are really intrigued and interested is, what does it mean to have poor, fair, good, very good, or excellent credit? So essentially, to a business or a lender, customers or consumers with higher scores are more likely to repay. So because they're more likely to repay, the charge, the interest that, or the fee that the lender charges the consumer to borrow the money, if you have a higher propensity that they believe that you're going to pay it, they're going to charge you less of a fee to borrow that money. They also, credit scores are also reported in terms of like buckets. So there are range scores here that if you fall within that range, you're considered in these particular buckets, which would qualify you for a certain amount, for a certain interest rate, for example, or will determine if you do qualify for a mortgage product. Generally, 660 is what we could consider prime. Access to safer, more affordable products really open up for consumers once they get above the 660 threshold. Generally, I advise my clients to target above a 700, 720. They're approaching the really good to excellent category that can make interest rates much lower or greatly increase your ability to be approved for a credit card, for example. There's not just one credit score either. Companies use different types depending on what kind of debt you're applying for. And they have different scoring models, and there's hundreds, if not, there's hundreds, if not thousands of different scoring models that are used. We're going to focus a lot on FICO here, just because it's the most widely adopted and used of the credit scores. And all of the scoring models, for the most part, go between a 300 and an 850. That's its band of scores that it compiles, that it's comprised of. So we have this slide here on credit matters, which we think is important. But I think we may want to pause for a second just to ask the second poll question. So Tita, if you could, excellent. So the poll question is this: what is your biggest concern regarding credit in the current economic climate, post-COVID? And really select all that can apply. Again, the question is, what's your biggest concern regarding credit in the current economic climate, post-COVID climate? And please select all of the answers here that apply to you or to the clients that you're working with. Okay.
You guys are gonna have another 15 seconds to answer the question.
And if you see my camera off, you guys, I'm just making it more comfortable to answer some questions in the chat. So as Jason presents.
Thank you, Jenny. Great. So our top answer here for the question, what is your biggest concern regarding credit in the current economic climate? Number one, with 46%, is not being able to make payments due to income instability. And we'll talk about some practices that might be able to help protect your credit. And unexpected expenses such as health bills at 32%. And then with 22% is I do not have any concerns related to some. So some people are in maybe better positions than others, but overwhelmingly it comes from income instability. And we'll talk about some strategies again that can help. So why does credit matter? Credit matters because the cost of there's a cost to borrowing money, right? Banks need to receive something, or lenders need to receive something for the risk of providing credit to individuals. And that interest, because of the principle of compounding, can add up to be a significant cost over time. So we have 4 slides here that are just talking about examples that I like because they're real world examples that are, happen to people every day. So there's a $15,000 new auto loan with a 5-year term, which is pretty common. Now to reduce payments, you see a lot of car dealerships or financing extend those terms to 7 years, which I'm not a huge fan of because it makes you pay more over time. But this is how credit could directly impact you. Let's say you have great credit score, 720 to 850. You go to a local credit union, you get a 3.7% interest rate. Your payments are going to be $274. And at the end of those 5-year terms, you might have paid $1,467 in interest. But let's say you have poor credit and you go to a buy here, pay here lot, or a dealership that guarantees financing no matter what your credit is. Generally, for them to do that, they're going to give you a really high interest rate, 14%, 11%, and we've seen higher, sadly. Your monthly payments would be $352. That person would have paid $6,122. That's more than double the person with good credit, for example, for the same amount loaned or borrowed. So just something to really consider. Mortgages. This is an example I use a lot with my clients who are really interested in buying homes. 1% interest rate doesn't seem like very much, but when you're talking about a 30-year term, and that's a long period of time in which the interest has to compound in a very large amount, 200,000, someone who's paying a 5.5% interest or someone who's paying a 3.9% interest, that's almost a difference of, $60,000, $70,000, $80,000. So that can be significant cost saving for the same price of home as someone else. It also, why we really don't recommend, and this is a myth that's perpetuated quite a bit that I've heard of, people saying you need to carry a loan balance, you need to carry some debt or balance on your credit card to get credit for that credit. That's totally false. Like Jenny had stated, the statement, reporting date, and the due date, what they want to see is that you're making those payments on time, And a best practice with credit cards is really to pay the balance in full at the end of the month. That way you'll never have to pay any interest. It's a free short-term loan that you've gotten. But carrying an interest rate, credit cards have higher interest rates generally, anywhere from 15 to 30% or if not higher. You know, that's a lot more money. This person with good credit would have saved $267 in 11 months of payments. And then emergencies. This is really important as well. And it's just something to think about where you're accessing cash when emergencies happen, and why credit cards can be a huge a big value add. For example, let's say you do have a car emergency and you need a car repair because you need to go to work. We really recommend avoiding anything predatory like a payday loan, just because those are debt traps and you can end up paying a lot more over time. But even with the credit card, you could charge a credit card, even though it has a 15% interest rate. If you paid at the end of that month, once you receive cash, you would pay no interest rate. And even at 11 months, you're only paying 38% in interest, $38, excuse me, in interest compared to $229 with the payday loan that's been rolled over twice, which can have astronomical interest rates. So how do you build your credit? How do you actually do something about it and find out where you stand? Well, it's really important to access your credit report, to review it, and then you can take action steps to improve it. So where can you find your credit report? You can get one free credit from each credit bureau from www.annualcreditreport.com. That's a website that's sponsored or hosted by the federal government. Make sure you enter that URL correctly. There's a lot of fake or scam URLs that are really close in spelling to annualcreditreport.com. But you can get all three of the credit reports directly via a PDF that you can download on your computer, or there's a paper form that you can send in and they'll mail you a copy of your credit report. It won't include the score, but the score is a function of the report. If you know what's on there, then you can work to improve the things that are delinquent or have gone into collection. If you've been denied credit, you can also request a copy of that report. Some nonprofits providing financial services offer free credit reports. So Boston Builds Credit, all of our partners within the networks. If you're a client who's receiving financial coaching, often those programs will provide you with free credit reports. At Compass, all of our participants receive credit reports for free as they are participating in the programs. And then online platforms like Credit Karma or Discover offers a free credit score. Credit Karma, like I said, there's a lot of credit models out there. So Credit Karma doesn't necessarily pull directly from FICO, but it may be pulling, Vantage Score, which is a credit scoring model created by the credit bureaus themselves to compete with FICO. It can be pretty close. And these platforms, although it's not 100% accurate, they'll give you a snapshot, a picture of what's going on, which is really valuable. And they tend to be, and they can alert you if something weird has come up. Where can you find my credit score? So banks, credit unions, lenders will give their customers free scores. So Bank of America offers a free score. If you're a Capital One credit card holder, they'll offer a free score. So asking just where you currently bank, if they offer these kind of services, many of them do. Again, some nonprofits that provide financial services, which you can learn more through Boston Builds Credit. Whenever you're denied credit or receive or are accepted or to extend to be able to receive credit, then you can also receive a report. Again, online platforms like Vantage Score from Credit Karma, CreditWise, and FICO Score from Discover Credit Scorecards, which I've mentioned. And then just remember, though, all those platforms may pull scores from different bureaus and use different models. But a lot of the considerations in those models are the same. So, on-time payments, the credit utilization, how much debt you have relative to how much credit has been extended to you. Those are going to be the most impactful actions. So the scores may deviate, but may be similar across scores if the reports show the same information. So this is an important one. What tools can I use to build my credit? Jenny had mentioned for young people, student loans tend to be one of the first places where they can build credit because it's one of the first kind of debts that are extended to you. And if they're federal loans, they're kind of automatic. You receive them if you qualify for financial aid. They don't really take in your typical, they're not looking at your score, especially if many of those people may be unscored. But for other people who are unscored, that means they have no score or maybe have poor credit. There are three main ways that we suggest or tools that you can use to build your credit. One is secured credit cards. So, normal credit card, unsecured credit card, based on your credit score, you have a risk assessment. They know how risky you are. And if you have a good enough score, they'll extend you the credit, and then you use the card and pay it back. They're kind of just extending it to you based on your word. A secured credit card, because if you don't have a score, your score is really poor, they may say, we don't feel comfortable because the risk may be too high, because we don't know enough information or the score is too low. So they're going to ask you for collateral. So secured credit card is really one in which you have to put some money down, which they hold in an account. You would use that credit card, and best practices, use it, charge something, pay it off in full. After about 6 months, you would generate a score. And then if the score is positive enough, the institution can convert that to a different credit product, like an unsecured card, and then they would refund you that collateral payment. So the collateral is usually your limit, how much you can charge. It's in case if you don't pay the credit card, they can take your security deposit. Secured loans or credit builder loans are another way. Kind of like secured credit cards, secured loans are loans that you're kind of making a deposit into an account beforehand, and then it becomes like a loan that you're paying in increments until it's paid off. Many credit unions offer these. There are products really similar to secured loans, called credit builder loan products that credit unions specifically offer, or CDFIs or nonprofit financial institutions may offer to help people build credit. And then the last way is to become an authorized user. If you have, let's say you have someone in your family, this is common with maybe young adults and parents who have good credit, they can add you as an authorized user on their card. Because you've become an authorized user, you kind of get credit for what they're doing with their credit card product. So if they're paying it off, paying it off in full, it's reporting as a positive on their credit report. It would report on a positive on your credit report as well. So it's really important as well that we just talk about the best practices. I've said these before, some of them, and I'll reiterate them again. If you follow these practices, they're really instrumental and really important to having great credit. So the first one is having an active account, 2, on-time payments, and 3, keeping low balances. So 1, active accounts. In order to have credit, we often see people, especially during VITA tax preparation time, where we offer free credit reports to people. We'll see people who, may not have a credit score because they don't have any credit. They don't have any debt. They've never had student loans. They've never had a credit card. Basically, they're unscored. In order to have a credit score, you need to have at least 1 active account. So active installment, which means, like a loan, it has to have a balance. You have to pay it monthly, and it can't be closed. So if it's a car loan that you just finished paying, it's no longer active. So it's not actually helping you build credit any longer. And then active revolving account, again, the myth, it does not need to carry a balance. And then at least one payment made in the past 6 months. If you don't use the card after a certain period of time, the lender can choose to close those accounts. So sometimes people will get credit cards, not use it for a number of months or years, and then all of a sudden it closes. And that can actually negatively impact your score because you lose credit history, and it affects your credit utilization ratio, right? The amount of credit you have available based relative to the debt that you have. On-time payment, super important, and I really want people to remember this. If you're really just having a tight cash crunch month, cash flow's tight, maybe you lost your job or you've been furloughed and it's really hard to make a payment, I think what's most important is to make the payment. Paying at least the minimum amount before the due date. Paying the minimum is not, you're going to pay interest, and if you just pay the minimum, and the debt is, you can accrue, it can compound over time, but you've made an on-time payment, which is, I think, most important. Again, carrying a balance past the due date does not help the score. Late payments can lower a score by over 100 points. It's really significant. Late payments can really hurt your score. It can continue to hurt that score for over 2 years. So you know, we tell people as much as possible, try to make those at least the minimum payments if you're having a tough cash month. And then collection and public records can lower a score by 100+ points. So once things are reported on your report on your credit reports as a collection or public record, so there's a bill you just haven't been able to pay or just forgot about it or you didn't know, that can really hurt your score as well. So you want to avoid that as much as possible. I'll say paying collections and public records can help your score a little bit, but it's, in my opinion, it's not very impactful. We tell people to really focus on the active lines, making sure those are paid on time. You can address collections for sure, especially depending on if you want to buy a house or move an apartment. You don't want to have opened collections because it can hurt your ability to get a mortgage or a new apartment. But you really want to focus on just avoiding late payments as much as possible. And then low balances. So Jenny also talked about this. You know, we're talking about specifically here around credit cards. You know, the best practice around credit utilization is 30-70. You know, you should not be charging or keeping balances above 30% across credit cards. So, you know, if you have $1,000 credit limit, you don't want to charge over $300, because once you have a balance over the 300, the utilization ratio goes from 30 to 50. You're using 50%. It really can drop your score significantly. So we always tell people to pay it in full or keep balances as low as possible, and don't take on more debt that you can't reasonably pay back. We really tell people to look at the total picture and see your cash flow and what makes sense based on your current financial picture and circumstance. And then lastly, a lot of people have this question: what can I do to protect my credit during COVID? There's many different reasons why your credit could be in peril during this time. One is just the amount of scams, from the stimulus payment to just robocalls to vaccine issues or other, you know, initiatives. There's many people calling people all the time trying to get information. Best practice: never share any sensitive information to any unfamiliar person on the phone. The IRS will not call you over the phone. Social Security will not call you over the phone. They send you mail, letters. Do not provide any sensitive information to anybody. If you're unable to pay a bill, given the circumstances, really contact your creditors before they contact you. Many credit card companies, mortgage lenders, car loans, they're working with clients today to try to change payment days, revise payment amounts. They'll work with you, and being proactive will allow you to kind of set the terms and put forward a suggestion that works for you instead of them dictating the terms of the agreement or what can happen. So we really suggest that be proactive, reach out to people. You'll be surprised. They want to work with you. They want you to pay on time. They don't want you to become delinquent. That doesn't help their business. So you'd be surprised there. And then lastly, situations like this happen in life, right? And one of the most important financial principles, you know, that we share with folks across the board is emergency savings accounts. You know, is a principal thing to set up and to have. COVID could happen, hopefully never again, but these things could happen. Jobs can fluctuate, can be a lot of, bad things going on in the world. It's really important to just create a budget and to start an emergency savings account. I suggest at least 3 to 6 months of total expenses. Best practice, deferring a set amount from a paycheck directly into a savings account. Just having that will just help you buffer any kind of storm that comes into the future. Great. So what can I do next? So let's say you're one of these people and maybe you want some more support and you want to talk to someone directly to kind of get started. We really suggest working with a financial coach for free on your goals. They can help you create a budget, build your score with safe products that they know of throughout the network, access free tax preparation, which I think can be a big cost savings for people, and then connect to other services like job training or home ownership, first-time home buying classes. And you can find all that information in bostonbuildscredit.org. That website would also have information if you're an individual who could benefit from one of our programs at Compass, from FSS, you're in housing, or someone who could benefit from business coaching from Jenny. So we really, stress to people to look at those resources. All right. Thank you. That was it for the presentation. So I'm going to stop sharing now so that I can look at the questions. And then Jenny and I can kind of go through them and try to answer as many as possible.
There is several questions, and we might have to tag team, but I definitely see a lot of questions about credit inquiries and concerns about credit inquiries. So I'll start off with those because I think I saw 3 questions and I did my best to answer around. So like I said previously, everyone, that there are 2 types of inquiries. There's a hard inquiry and there's a soft inquiry. Hard inquiries are whenever a financial institution, cell phones, whatever, is trying to pull your credit report and they are requiring your social security number. Hard inquiries impact your credit score. So usually when you have a new line of credit, you'll see your score depending a drop anywhere between 10 to 40 points. But oftentimes they bounce back as time progresses. Inquiries last on your credit report for 2 years. The impact of it really is a year. Okay, so that's hard inquiries. Soft inquiries is whenever you're checking your credit report. So when you look at tools like Credit Karma or My FICO or Experian, whenever you're looking at your credit report, that's not going to impact you. That is a soft inquiry. Another thing that I think Todd said, which was great, is sometimes credit card companies that you already have, they check your credit score in order to decide whether to increase your line of credit. Because you already had an open line of credit with them, like there was already a hard inquiry to open the account in the first place, whenever they check your credit score to increase your credit limit, that's a soft inquiry. So it's not going to negatively impact you because you already have a line of credit. Does that make sense? Let me know.
Yeah, I would say, just to add to, whenever you're applying for credit, you're actually looking to extend credit to yourself. Either you're applying for a credit card, a mortgage, or a loan. That's a hard inquiry, and they will pull your score. And like Jenny said, it impacts your score 10 to 40 points for a year to 2 years. Anytime a consumer is reviewing their score, and this means like when agencies, like if you went to get coaching at one of the organizations and they pulled your score, those are soft pulls and they do not impact your score. That's a great question. There's
another question, and you can answer this if you would like, Jason. What happens to my credit score if I close a credit card account?
That's a good question. So generally we advise against, it depends. Many of these questions, it depends, because you want to look at the full financial picture. If you have a credit card where the person has continuously been, if as an individual, you've continuously made late payments, you get into trouble using it, closing the credit card account might be the best decision. Right? Get yourself in trouble. But just in terms of credit, and there's nothing wrong with that. But what I'll say is in terms of just closing the credit card account, we suggest against it because it hurts your score in really 2 ways. One, you lose credit history. So like if that's the oldest credit card account you had, it might have had a really big impact in the score because you've had it for a long time. So closing that you would lose essentially some of that history benefit. And then the other one would be the credit utilization ratio. So remember what I said, like you have a total limit and that's all the cards together. Or all the the revolving lines of credit. When you close one of those, that limit decreases. But if you have a balance, that's going to mess with that ratio. That's going to decrease the ratio or increase the amount that you're utilizing. So that would hurt the score. So we've seen this happen. People pay off certain credit cards, close them, but because they closed them, their credit limit went down, and actually their score went down because the utilization ratio went up. Right? They were actually using more of the total credit that they had available than before they closed the credit card accounts. Having multiple credit cards does not hurt your score. It's really about the use. As long as you're paying them in full or paying them on time and not making late payments, keeping debt at 0 or none, that they're going to be a benefit to you, if anything. We had some other questions here. I know someone said a housing one specifically, or let me look at the Q&A. If my payment is due on the 24th at Capital One, when would they report? The report date varies from institution, so you can ask Capital One directly, and they can tell you when their report date is. It might be on the statement as well that you receive. We've answered this. What happens to my credit score if you close a credit card account? One person had a specific question around housing subsidy agency. I'll say this: asset limits are important. Around savings, there's asset limit caps. You really want to talk to your leasing or officer that you work with. Generally, there's asset limits that are pretty high. So, I think for BHA or Cambridge Housing, it's like you can save up to $50,000. So there's a lot of in my experience, a lot of misinformation around rules in housing. So I would say just talk to your leasing officer and ask them those specific questions.
Oh, there's a great question that just came up. Outside of COVID.
You guys want to answer one more question? And while you guys decide on that, I can do the exit poll so folks can get ready for a wrap up. I'll also be dropping ways to contact Boston Builds Credit in the chat. So if we don't get to your questions, you can send an email or contact them through the website, and look out for a follow-up email from us.
That's right.
Thank you. I want to say this to everyone. There in our Boston Builds Credit Network, there is so many partners that are doing workshops. They are teaching consistently on credit. We don't want anyone to feel like this was a catch-all, be-all. If you still have questions, please connect with Boston Builds Credit. We actually have links that we created just for you guys, that when you share with us what's your email for now, you will have access to 3 specific resources that help you when it comes to collections. Just understand the general shape of what's happening with your credit, and you will have access to us overall within the network. We can connect you with different partners, because I know there were a lot of specific questions about what's going on within your personal finance.
That's right.
And we know that personal finance is, again, personal, and this format doesn't allow you to feel as heard when it comes to your questions. And we understand that this is important. This is an important conversation to have. So please, please, please connect with us. We are excited to help you. We are willing to help you. So please connect. And then I will end with this question. I did see someone named Calvina. There were several responses to your questions that I placed on the chat, so feel free to look back when you get a chance. But one of the last question is, what if the credit card company closes the account for inactivity? Is there a way of asking them to reopen it and reflect the history I had before? Fantastic question. And unfortunately, the answer is they won't open that same account, and it will reflect your old history. What happens is when you call it, they'll open, it could be considered a hard inquiry because it will be considered a brand new card. So the payment history will no longer be there. It will be a fresh new payment history. And Jason, if you want to add anything to that.
Yeah, so remember, the history, positive or negative, remains in the report for 7 years. So whatever history you have with that card is going to remain on that credit report.
Mm-hmm.
You can, as Jenny said, you can ask them to open a new credit line that's in a replacement for that one. But that will be a new line that will be reported on your credit report. But just because it's been closed doesn't necessarily, it's obviously not great, but you'll still get the history of what you did with that card will remain on the credit report. Okay, it may no longer actively impact you, but the new line, if you're able to open one, should help you. Okay. Great. So we have an exit poll here. If everyone can answer it for us, it would be wonderful. I guess we can, you know, it's 1:02. We're mindful of time. I know people are dropping out now as they have other meetings. It was a pleasure for me to deliver this with Jenny and to all of you guys, and for the state to have us, and Allison. And just thank you. And if you guys have any questions, please reach out, and, you know, we can be in contact and answer some questions. But we're here to help everybody, and good luck on everybody's credit journey.
Thank you, Jason, Allison, and Jenny for being our lovely panelists for today. Thank you to Boston Builds Credit for helping us set this up. I did drop in the chat the contact page for Boston Builds Credit. So if you guys didn't get your questions answered, please submit an email at that website, or you can email me directly and I can connect you. moneytalk@tre.state.ma.us. I'll drop that email one more time in the chat for you all. And I won't take any more of you guys' time. So thank you, thank you, thank you. And I do look forward to doing future Money Talks, hopefully with you soon. And enjoy the rest of your afternoon.
Yes.
Bye, everyone.